So I'll start by introducing myself. This is Ron William, Principal Market Strategist at RW Advisory. This is a new firm which has just been launched early October. So big congratulations to all of the hard effort that's been put in there. And I'll talk more about that probably during the introduction of this webinar and maybe future webinars if you have any questions. For any questions that you have about the webinar we're about to start discussing, please feel free to email me on ronwilliampr@gmail.com. ronwilliampr@gmail.com. I'll say it one more time, ronwilliampr@gmail.com. And of course, you can also connect with me on LinkedIn or follow my Twitter, which is ronwilliam7. For following me on Twitter. Okay, so that's a quick kind of overview. The discussion today, a very topical discussion. Gold, a unique buying opportunity, which must be successfully timed. Now, I feel it's important to give an overview of the trading approach that I followed over the years. It's been well over 13 years that I've officially been in the market, a lot longer previously before working with various institutions. And probably the highlight of my career, as I tend to say, in terms of learning, was probably when I spent a few years at Bloomberg, the financial media company, working as a technical analysis specialist and basically visiting their clients across the world, helping them advance their trading analysis, but then also trying to maybe develop some of the new tools that people wanted to be implemented. Probably, to be fair, in addition to that, a lot of my practical experience in terms of trade strategies has been in and around the time at Bloomberg when I was working at various institutions and developing strategies for banks and hedge funds. Now, throughout that time, 13 years plus, I've gone through a lot of complicated, sophisticated analysis and basically mean reverted back to where I started, but this time filtering out a lot of the noise and trying to basically keep it simple. And you've probably heard that said by quite a few kind of people in the market, that simple is usually best. Now, the simple type of analysis I use is a top-down macro approach, which is semi-discretionary. So I look at a lot of subjective and objective filters when I analyze the market. And I begin with this pyramid, this upside-down pyramid here, focusing on the macro big picture. That tends to be done by looking at cycles, long-term historical cycles, and also understanding certain intermarket relationships or correlations. Following the macro big picture analysis, I then work my way down and look at the internals within the markets. And there's a whole variety of quantitative and qualitative indicators that I look at. Quantitative, so think of your standard technical analysis indicators, momentum, volatility, liquidity. Quantitative actually includes various other proxies such as the options market, liquidity, capital flows, fundamental indicators, economic indicators, so other non-price type indicators that also do give you an interesting perspective on the market. So quantitative and qualitative indicators is what I've always used for years, but I'm probably being a bit more broader in my explanation of what I use in this webinar more than other webinars that I've given with FX Street. And then last but not least, of course, the short-term trade setups is all about timing. And within that, my specialization areas are candle patterns, Japanese candle patterns, which is something I've used for many years, started using from early on within my career, and more recently, in recent years, DeMark indicators developed by the one and only Tom DeMark, a very famous and quite prestigious practitioner within the industry that has developed his own suite of indicators, which are predominantly contrarian, so they look for turning points in the market or exhaustion points in the market. And so that fits in with my kind of focus and need for market timing. So quick Quick summary: macro analysis, cycles and correlations. Internals, looking at quantitative indicators and qualitative indicators. Timing, and that's more for the short-term setups, specifically candle patterns and DeMark indicators. Now, I always like to include this slide, just restating the point that this is a global webinar. It is always an honor and a pleasure to host these webinars in association with FX Street. And one of the wonderful experiences I have is just knowing that there are many people from across the world attending these webinars, some within the Western time zone, so people who are kind of, it's daytime in the country that you're in, but also I've been very surprised to have attendees graciously attend very late nighttime hours from Asia. So it just shows the dedication that people have across the world to learn and to share ideas. So in this question, in this kind of slide, I would like to ask the following. And some of you who have attended my webinars before know what I'm about to do. New people will just have to kind of enjoy the surprise. Please introduce yourself to a neighbor, i.e. to each other. Talk about your name, who you are, country, what markets you focus on, and maybe strategy that you look at. But probably one of the key things I want to know is have you attended my webinars before, or are you a new attendee? So if you could just quickly kind of fill the chat with that information. And most importantly, remember to smile. If possible, just to kind of keep this engaging and fun. So we have one person today from the USA who's attended my webinars before. Any others? Poland? Forex girl with a big smile. Thank you. Paul Volker, yes, he's an attendee. Hans from Germany. Carl from USA, new. Welcome. I saw Mike there from the USA. Carlos from the New York. India, new person. China, Shanghai, so that's a late night time zone there. Thank you so much for attending. So we have quite a few there, and it's always a joy and a welcome surprise to have so many people. Just a few others: Nigeria, new. UK, previously, and a few people who are enjoying the picture. No, this isn't a picture of me as a baby, but I thought this was a humorous picture that might keep a few of my attendees kind of in the learning mood. Okay, I'm going to move on now. So the point behind this is that so many of us are living in wonderful countries around the world, all with different trading techniques and all with different interests in the market. And so really, each of the webinars that we organize, that I organize with FX Street, I really want to make sure that we're able to connect with each other as a group, but also that we share ideas from each of the countries that you are located in, and each of the kind of investment focuses that you might have. So please feel free to keep this as interactive as possible. Okay. So I always like to begin with the end in mind, I usually break my webinars into 3 sections. This webinar is all about gold, and it's just a quick overview on 3 parts. Part 1, short-term outlook. Part 2, long-term outlook. And Part 3, a few strategies, which I'll end off on. Part 1, we're going to start off with a quick sentiment survey. How do you feel about the gold market, both in the short term and the long term? A quick point from me about the current price activity, key levels, and then one point I want to make about gold interplaying between a safe haven market but also a risk market over the last few months. Part 2, the long term, timing is everything. Really want to make the point that a lot of people out there are bullish on gold, but what time frame are you bullish on? And the problem that we've had for almost the entire year of 2012, as gold has been moving sideways, is that there are many people out there that are bullish, they're positive on gold, because gold is just, more than quadrupled in value over the last 10 years. So it just makes sense to continue to extrapolate that trend higher and believe that that trend will continue to be your friend. And that is likely to be the case, but we have to keep in mind that timing is everything. Markets can go sideways for a year, which is what happened to gold. And during that time, we have to ask ourselves the question, what do we do? And why has the market changed its characteristics? We have to always readapt to the market environment and continue to ask ourselves questions about our old views to make sure that we don't just marry our views and not change them when the market changes. To that effect, I will then talk about the big picture. Where are we in the cycle? And of course, cycles is a big advantage in knowing where you are within the roadmap of market movements. And then I'm going to talk about this $2,000 glass ceiling, which eventually I believe will break out, but keep in mind we haven't yet. Part 3 is actually going to be quite a quick part, so it's just going to basically talk about the unique opportunity, buying opportunity, which I think will exist for gold next year. And certainly before that buying opportunity appears, I shall do another follow-up webinar on gold. Okay, so I want to ask this question with this wonderful James Bond caricature of two cartoon characters, a bull and a bear, and some questions each of you here within this webinar from all across the world. Are you a gold bull or are you a gold bear in either the short term or the long term? So Rahul saying bear side. FX Boy is saying bull. If you can tell me which time frame, short term, long term as well, and maybe give me the reason why you're bullish or bearish. Needs to correct fair value. Very good point. So you may be suggesting that the market is overvalued and needs to kind of mean revert back to that kind of fair value. Mike is saying that he's more a gold scalper, so maybe focusing on the micro intraday short term, so maybe not so biased about this. Ray is saying no clue. Thank you so much for being honest. And to be honest, the gold market has been moving sideways, as I said, for about a year, so it's understandable. Eric's saying short-term bear, long-term bull. U.S. real interest rates maybe being a proxy for the gold move. I think I know what you mean in terms of maybe rates pushing higher and creating inflation and maybe compounding the upside. Rahul saying this decade will witness a huge fall. Interesting. And I'm just going to wait for just maybe one or two final views. Ahmed is saying gold trading is not for small traders like me. And Carl is saying bear, short, bull, long, debt is not going away. So you're looking at the kind of hedge against government debt and that kind of big tail risk getting much worse in the future, and how gold is seen as a hedge for this. Being a kind of a hard asset that you can invest in versus a lot of the worthless fiat assets out there, notably currencies, losing their value as governments continue to print more money. And at some point when inflation does increase, and a lot of people do believe inflation will actually start to show itself maybe next year onwards, gold will maybe be the best hedge against political and economic instability, but also inflation and many other risks out there, both economic and political. Okay, I've tried to read out as many of your wonderful comments as possible. It's not so easy, by the way, with this new format that we have. It's easy for me to read your comments, but the comments don't stay on the screen for long. So I'll probably kind of do a workaround for that for future webinars when I have two screens to work off. Okay, so are you a bull or a bear? Most people seem to be undecided. I think most of you are 50% bulls and 50% bears. So it's quite interesting. Let me see if I can resize. Let me see if I can do that actually. Thanks, Mike, for that tip. Very good tip. Now the problem is I cannot resize it vertically. So let me see if I can do it this way. Okay, I shall kind of revert to that chat now and again. If this gets in the way, guys, just let me know. What I'll probably is get rid of it for now. And then open it up whenever I ask interactive questions, because I want to make sure you've got maximum viewing space of the charts that I'm showing you. And I know the FX Street guys are recording this, so I just want to make sure everything's okay for the recording for the other slides. Okay, are you gold bull or are you gold bear? It seems to be a 50-50 split, 50% split both ways. And some of you are talking about technical reasoning. The market's been overextended and needs to revert back to a mean and an average fair value, which could be a moving average or could be maybe a fundamental kind of point that you might be looking at. And then a lot of you are also talking about the whole safe haven trade, that maybe gold is still that safe haven trade which will hedge you against worst case scenarios like inflation, like political economic instability. And then some of you are just saying, well, actually gold's just going to head down lower for other macro reasons. So a mixed perspective. Now this is, I just want to focus on the short-term price dynamics, start off with that, and make the point that I made yesterday on my media interview with Bloomberg Television on their countdown show early in the morning. I mentioned gold is one of the key markets to watch following the sharp reversal from just beneath $1,800. And the key point I made there is that gold, like every market, underwent an unsustainable acceleration. And so the rule of thumb that was taught to me many years ago by one of my mentors is that any market that experiences acceleration will have some kind of unsustainable experience that shall reverse. Basically, acceleration is unsustainable in the short term. And certainly gold did teach us that lesson after gaining about 10% in the very last 5 weeks of this breakout from that triangle that you can see there. It was a 10% gain in only 5 weeks, so just a very impressive bull run. But of course, you can see there by the angle of the rise, it's quite a steep rise, and also if you can see the bullish candles, the big white candles along that rise, it was very overcrowded, very bullish, and at some point in time, that acceleration needed to unwind in the short term, and that's what we're seeing now. Now, part of the reason why we had that reversal is not just because the market moved too fast too soon. Momentum was, very exhausted, but also because we had basically hit a critical level at around the February 2012 peak and the November 2011 peak. Now, that level is around $1,800, but also if you were to draw a classic trend line, you can see that we had a minor breakout above that trend line. We failed to hold above that and push back lower. But generally speaking, there's formidable resistance around the $1,800 mark. And interestingly, if we look at past historical examples back in November of 2011 and February of 2012, you can see how the markets resolved after unsustainable acceleration. So you can see the green arrows there showing you the market accelerating in a very short space of time, moving very fast, very soon, and then spending an equal amount of time reversing to the downside and finding that fair value that some of you mentioned. Again, in February 2012, massive acceleration, and then another mean reversion down back to fair value. Now, what is fair value? We'll find out over time, but it seems to be the swing lows of 2012 and 11 and 12, which I remember to be around 1525. That is certainly a key support level. But keep in mind historical parallels in November of 2011 and February of 2012 acting as formidable resistance at $1,800, but also reminding us that anything that moves too fast too soon, while it might be very beneficial in terms of money that we make, we also do take a lot more risk, and then potential kind of reversals do trigger to the like that we're seeing right now on gold and have seen in the past. Okay. The indicator at the bottom, by the way, if some of you are wondering, is the RSI momentum indicator, and that is just showing you that at each of those times the market became overbought above the 80 area, and you can see now from the massive overbought area that we had most recently, just here, the market is now pushed structurally lower. The RSI indicator is pushed structurally lower back into the 38 region, and still isn't in oversold territory, by the way. So there is still further downside scope based on the daily chart and the 14-day RSI momentum indicator. So although we've had a dramatic reversal, there's still more to go. Any questions on this chart? I'll just pause for a second just in case any of you have any questions. So here we're just talking about historical parallels. Mike's asking, do I use a standard 14-day for the RSI? Yes, I tend to use 14-day for RSI for a number of reasons. And that is what we're looking at. Of course, you can optimize the indicator, make it more sensitive, or make it more of a lagging indicator. It all depends what you want. 14-day RSI tends to work for me. If you increase the, if you make it more than 14 days, if you increase the parameter, then it will lag and probably be better for confirmation signals, so you don't get too many whipsaw signals, too many false signals. And of course, if you change it from 14 to a lower value like 9, then you'll make it a lot more sensitive, maybe get early signals, but of course you might get a lot of false signals as well when the market is volatile. So it all really depends on your trading mandate. But 14-day RSI works best for me, and I'm really not using it as a trigger indicator. I'm using it more as a confirmation indicator. So I tend to use the RSI indicator for measuring overbought and oversold extremes, but also to letting me know when that market is in a very strong trend and will remain overbought or oversold for a continued amount of time. So keep in mind that overbought or oversold doesn't mean that it's going to reverse immediately, but it is a good kind of T-juncture point to be aware of when we're looking at the markets. Certainly in the case of gold, you can see not only was it overbought, but there was a very strong divergence signal, i.e. The gold price was making new highs around the $1,800 mark, whereas the RSI was making lower highs, so just suggesting a divergence there in terms of internal momentum. Okay, and I think most of you already use momentum indicators such as the RSI. Okay, now if we look at just a basic moving average setup, I'd like to look at the 20-day moving average for a short-term measure, the 50-day moving average for medium-term, and as probably all of you already use, the 200-day moving average for the long-term measure. And this is partly how I monitor just classic market cycles. I just use basic moving averages. And you can see here that the reverse that we've seen in gold broke beneath the short-term trigger at 1756, that's the 20-day moving average, the medium-term trigger at 1726, which is the 50-day moving average, and now targets, as you can see there as the headline, 1660 or 1663 if you look at the current price of the 200-day moving average. So 1660 is certainly a near-term figure that we should all really keep in mind. Now, one thing I'll just quickly draw on the chart, and I'm going to draw this with a pen, so it might not be as straight as I would like it to be. But keep in mind, if I can draw this, that there's also support level around here, which I know this isn't the best technical analysis that you've seen, but since we're doing this webinar live, that comes in around 1625. So just keep in mind that there's also that triangle old ceiling resistance or support now at around 1625. But my point is that between the 200 moving average and between that old resistance, new support, this will be quite an important zone for gold in the near term. So 1660. Between 1660 and 1625 is quite an important support zone to keep in mind, where the market might pause momentarily. Rahul's saying 1684 as being another area. Possibly, I'm sure each of you will have your own individual kind of levels as well. Ray is saying, do you have US ticker symbol for gold? Yeah, so I'm looking at gold futures. Okay. Now, one point I want to make is once we get over the near-term target of 1660 to 1625, keep in mind that gold can fall much lower than that in the short term, and that is based on just very simple wave equality analysis that I do. And all that means is a market price swing in the past is equal to another market price swing that took place shortly afterwards. And then that historical evidence of wave equality suggests that we might see history repeating itself again in price terms. And so we can see there the November peak of 2011, the February peak of 2012 this year, both reversals equated to a 15% drawdown in gold, and we might see that happen again. Third time around, and usually the number 3 tends to be a synonymous number within life and within market analysis. So usually if you see something happening twice, the third time has an increased probability of repeating as the prior 2 times. And certainly we've already had kind of strong reversal signals already beneath that $1,800 mark. So just keep in mind that we could basically have a repeat of history, 15% down from the recent highs, as we saw February of this year and November of last year. Okay. Any questions about this chart here? Just very simple chart, and I really encourage you to kind of just include kind of market structure analysis or search for wave equality as potential ways to understand the characteristics of the market, but also to actually make fairly objective observations about price movements and how far they can rise or fall based on historical price activity. Any questions on this? 15% drawdown, we've seen it happen twice, and we might see it a third time. And of course, keep in mind that rough 15% drawdown, if I can draw it here one more time, is also this key support area, which is around 1525. So basically, we could just mean revert back to 1525, which I would say is maybe a technical fair value level within the multi-month trend or the 1-year trend, which has basically been sideways. So gold is just basically choppy, sideways, volatile market within this massive 1-year trend. And remember that 1-year trend began when the gold market attempted to break above the $2,000 glass ceiling. We missed it by a small margin, and we've just been moving sideways ever since. So whether you're bullish or bearish on gold, we have to pay attention to the market dynamics and what we've experienced over the last year. Now, of course, if you're a short to medium-term trader, the one thing I should say is, of course, you could have made money on the price swings, and this type of price swing-oriented market can be very beneficial for you. So, of course, the market might go up 15%. You could have, bought on the back of that rally, down 15%, you can sell on the back of that decline. So sideways market isn't necessarily a bad thing, unless potentially you're a long-term investor, like a lot of people I know and clients and friends alike, and you're a multi-year investor. Then of course maybe you would have either kind of not made as much profit as in previous years, or maybe broken even, depending upon when you actually entered the gold market. So really, if you are a trader, and I think most of you here within the FX Street webinar are short to medium term traders, then this sideways market might be a profitable swing trade environment for you. If you're a long-term multi-year investor, then you might need to kind of hold on to your investment ideas until gold potentially breaks higher above that $2,000 level, if that's something you believe will happen. Okay. Now, interestingly, I want to make the point that as gold reversed, gold is actually acting as an interesting leading indicator for the risk markets. Keep in mind that gold hasn't really played as a safe haven market for the duration of this year. It's been more of a risk proxy, i.e., when risk appetite increases, gold increases in value, and when risk appetite decreases, gold loses value. And that's also been, of course, the case with traditional markets like the S&P 500, Eurodollar, Aussie dollar, so some of the commodity currencies, some of the US equity markets, which also have been thrown into this kind of traditional group of risk assets. Gold is probably the non-traditional addition to that group, but certainly it has proved itself as a new member of that group for this year. Now, the chart here that I'm showing you is just showing you that there's a key inflection point now on the S&P 500 as gold has already reversed. And Ray's just making a point there that I think he was just making a point about the actual turn and volatility being low, the VIX index being still at low levels. That is partly why the U.S. equity market specifically have been so bullish, especially the last few weeks. October is usually the traditional month for increased volatility as traders and investors come back to their desks and volume starts to return to the market. Volatility traditionally increases during October and November. We have seen very low volatility this month, and so as a consequence, it's given the risk proxies, the markets which are associated with higher risk appetite, it's given those markets another squeeze to the upside. It's allowed them to kind of stay much higher for longer. And the point I'm making here is from a technical basis. Keep in mind that the market has a price and time memory. The market has a collective memory of the past. And in price terms, the S&P 500 is still pressured by the 2008 crisis levels at around 1440. I went on the record twice on television to actually talk about this level, and a lot of people thought that, you know, if you're a traditional trend follower, then you just expect the trend to continue higher, and that is probably the best thing to do. But just keep in mind that when we're at these key price inflection points, that we need to be a bit more cautious. We need to maybe use trailing stops. We maybe need to have better risk and money management, and not just blindly ride the trend. It's good to be a trend follower, but always know that the trend can stop and reverse. And so we seem to be stopping and reversing at this 2008 crisis peak at 1440, which coincidentally ties in with the following the turn on gold. Eurodollar, also I don't have that chart here, but Eurodollar has paused at around 131.20, that key resistance level, Fibonacci resistance level of the prior swing trend, and is now reverting back to the 200 moving average. So a lot of risk proxies, traditional and non-traditional, are at key inflection points right now. Now the very last point I'm going to make here, remember I said markets have a price and time memory. Well, on the time side, the S&P 500 rally that we've seen, what I'm calling a bear rally, has lasted more than the average cycle duration. So from 2009 to date, I'm calling this a bear market rally, i.e. a short-term rally, or let's say a short-term in terms of the very long-term, decade-long sideways trend, a bear rally which has lasted for around 44-45 months, and that's above average. So that's just suggesting exhaustion both in price terms, the 2008 crisis peak at 1440, and time terms, the actual duration of this bear market rally within the longer term secular trend, bear trend. Any questions on this? So I'm just on 2 or 3 points. One, I'm making the intermarket statement here that it's interesting that if we just focus on risk appetite as a theme, that gold, Eurodollar, S&P 500, and a few other risk appetite related proxies are all at key inflection points. Gold seems to be leading the way. Remember, gold reversed much earlier than all of these markets, most of these markets. And if we look at the popular S&P 500, which is seen as a very good indication of risk appetite, investment risk appetite in the market, which has been very positive since the summer of this year, and certainly since 2009. If you look at it from a long-term perspective, we are now looking like we are hitting a key price and time inflection point. Any questions on this? So the intermarket point I'm making about risk appetite potentially becoming exhausted and turning, and then I'm using the S&P 500 as a traditional proxy, showing that we're a key price and time inflection point. I'm going to pause here just for a second to see if there's any questions. Any questions on what I've just covered? Just going to open the chat. Just check some other questions. So Ray's asked, the S&P 500 seems to be retracing. The VIX is going up. I thought gold would be a buy. Very good point. Keep in mind that the traditional relationship of gold going up is valid, but just not at the moment. So these relationships are just temporarily not working. It doesn't mean that they don't work anymore, but just keep in mind that sometimes these relationships just disconnect, and it's just how markets work. Mike is asking elections outcome and impact on the markets. Very good question, and I'll get to that towards the end because just a quick heads up point that the next webinar I'll be doing in November will be about the markets and the US elections. So I'll be talking exactly about that, Mike, in my next webinar, so feel free to tune in then. But I might say one or two things about the elections now, which is obviously on everyone's mind with the U.S. election debate on televised debate, which has been taken center stage, and of course, a lot of market punters which have been talking about how you should be investing pre and post elections. One point I'll make that to follow up on Mike's question, just to be fair, a lot of people are waiting for a U.S. equity rally into the election period at the end of the year, and historically that is the case. Each election period over the last few decades, over 50 years worth of history, the U.S. equity market and equity markets generally do rally pre-election for many reasons. But one thing I want to make is it does not mean that the market will continue to move up in a straight line between now and then. And the problem is a lot of people at the start of 2012 thought that we would just have a positive year for the entire year because of the US elections. Keep in mind that we have to think in terms of multiple time frames. So we have to think about quarters of the year, quarter 1, 2, 3, 4, monthly durations, and how things can change around. Okay, I'm going to just speed up now just for the sake of time. Okay, so part 2, we're just going to talk about timing is everything, big picture. I'm going to talk about the long-term cycle, and then end off on part 3. And just for some of you who are interested in the next webinar on markets, influence, and the US elections, I think the FX Street have just put it in there in the chat, so you can just sign up at the end for that webinar. Okay, so timing is everything, and this is a picture that I often use just to kind of remind people why timing is so important. This picture of a jaguar, and so just the question that I want to ask you guys again is what do you see when you see this picture? What do you feel? So most people say speed, but what else do you see other than speed? If I could just get a quick. It's a cheetah, so a few debates as to whether it's cheetah or a jaguar. Uptrend, predator, yep, thank you very much. Strength, out for blood, that's quite a deep kind of illustration there. Anything else? Spots. So that's a lot of visual thing, but tell me about the emotions. So confidence, focus, yeah, that's probably more what I'm pushing for. So confidence, focus. These are all the key things, and speed, and as someone just said, it knows when to pounce. So very, very good points there. And this is probably the key message behind the slide whenever I show it in the webinars. This picture is a great picture, in my opinion, just to illustrate the point of timing, market timing. And keep in mind that whatever macro view you have on the gold market, you really have to think about it from a market timing perspective. How as you do with any market, but the problem is that gold's just become such a fantastic trade over the last 10 years or so that even as traders we forget that timing is critical because we are just so blinded by this wonderful uptrend. Remember, the trend is your friend, so we just continue to extrapolate that trend higher, and we become emotionally blinded by the profits that we make from that trend. But even from a fundamental macro perspective, we keep on arguing the same points. Gold is a great hedge against inflation. Gold is a great hedge against fiat currencies because the governments around the world are printing money like there's no tomorrow, and so it makes currencies worthless. And so gold is the hard assets better than the non-tangible assets like currencies and various other things. And so we start to kind of optimize the reason why we're bullish on a particular market. We marry that view. We get married to that view. And this is just a trap that we all experience. But at some point in time, we have to look back at the chart and say, at which point is my analysis either on hold or wrong? And so that's the great thing about looking at charts. We have price levels which either tell us when to stop put our analysis on hold, or in some cases actually change our view because the market dynamics have changed. So that's the only point that I'm making here. So I hope each of you can relate to that. This picture of the cheetah or the jaguar, whichever animal you think it is, the key emotional lessons from this picture is speed, focus, patience, and just general timing. And certainly timing has been a key thing for the gold market ever since it almost hit that $2,000 mark, failed to break above the $2,000 psychological ceiling, and at that point we really should have stopped with the long-term bullish views for gold, both technical and economic fundamental, and started to kind of actually just focus more on the price dynamics. And the price dynamics have been sideways for the entire year, with a lot of price swings. So if you're a trader, you can maybe take advantage of that. But just keep in mind that you really have to be focusing on the price dynamics more than the macro reasons for trading gold, which has been valid for over 10 years, but just have been on pause for this year. Okay? Is that clear to everyone? Can I just get a few yeses or nos? Feel free to tell me no. It's okay, so some people are saying yes. Great. So it's just, as much as possible, we need to learn from from the changes that the market is producing. Okay, thank you, Mike and Forex Girl for confirming. Let's move on now. Okay, so timing is everything, and that's the point of this slide of the cheetah or the jaguar. Speed, focus, patience, and timing, and this is really valid for the gold market or any market which has moved too fast too soon. It tends to go through a sideways recovery stage, and gold has been doing that for the duration of this year. So we really need to be focusing on the price dynamics more than the macro arguments, which are just temporarily on hold. Okay, now part of the reason why the bullish argument for gold is temporarily on hold, the technical argument and the macroeconomic argument, is because cycles exist. And gold is certainly tracking a unique cycle of its own, a long-term bullish cycle, but of course that long-term bullish cycle, if we look at the multi-year cycle on this chart, the big fat blue line, is interrupted by other cycles such as the medium-term cycle or the short-term cycle. Remember, medium-term is usually 3 to 12 months, short-term is usually anything from 1 to 3 months. And you can see medium-term is the thinner light turquoise zigzag interplaying with the long-term cycle, and then short-term is that red dotted cycle, which is a bit more sensitive and probably more for trading purposes. Now, I haven't drawn it here, but I would say that gold is roughly around this point here. Is that clear to everyone? So I'm going to write it there. Gold is roughly around this point. So we have basically experienced all of this upside now since 1999 up until 2011, and probably 2012 and maybe early part of 2013, it's this period here. It's basically the big drawdown that we're seeing in a medium-term cycle, which will inevitably settle at a key kind of support level of that long-term multi-year cycle. Is everyone okay with what I just said there? Because this is actually quite a critical point. This is what will set you up for the biggest buying opportunity on gold into 2013 and maybe 2014. I need to do more cycle analysis to actually work out the latest timings for the gold upside potential. But for now, most of my analysis, short to medium term and long term, is suggesting that we're going to go through a sideways to negative decline period. I've mentioned 1660 and 1625 as a near-term target, but of course 1525 is still very much a possible target that we might see over the next few weeks and months ahead. So in terms of price targets, 1660, 1625 is a near-term zone. Remember, based on the momentum short-term indicators, we are still not oversold, so there's still downside possible in the market. And remember, 1660 is the 200-day moving average, 1663. 1625 roughly is that key resistance, old resistance, which is now support from the triangle ceiling, the old triangle ceiling, and 1525 is the old swing lows. And remember, that also ties in with the 15% wave equality that we've seen in February of this year and November of last year. Is everyone able to follow what I'm saying here? So I'm just going to quickly open the chat, because I tend to show as many slides as possible to explain my point, but when I don't, I want to make sure that it's clear to you. So if you're listening to what I'm saying and if you understand what I'm saying verbally, then it should be fine. So Mike is saying crystal clear. Is that what I've just said very recently? Is that what you're referring to, Mike, or previous? Okay, great. Okay, and I'm hoping everything else is thanks, last one. Thanks, Mike. Okay, so I hope that everyone else is clear on this. So Haitham is also saying it's clear. So all I'm saying is gold is definitely bullish over the multi-year, long-term time frame, and you don't need me to tell you that, because you've clearly seen that gold has quadrupled in value since 1999, and that's why so many people are bullish on gold. But keep in mind that for the duration of this year, gold has been moving sideways, and that is partly because the medium-term trend has turned and got moved sideways, but actually, in my opinion, will actually maybe push lower on the short-term basis to 1660, 1625, and then 1525 potentially as a floor support level. I don't think we will get much below 1525, but if we do, I'll probably mention it in future webinars, just to talk about tactical perspective that I think would be quite useful if we break beneath 1525, because we could do that. I think it's less likely, but if we do that, there is certain further downside levels which I would need to speak to you about before we get that big move higher in the long-term cycle on gold. Okay, so if there's no questions, I'm going to move on now. Is that okay with everyone? I'm just going to do a quick final check. I'm not talking about all of the indicators I use at the moment, but maybe if you send me an email, I can tell you about the TD sequential setup on gold. But for now, it's more downside play on the momentum side. Okay, so we just have a few moments left, so I'm just going to quickly wrap up the remaining part of the presentation. Remember, part 3 is a very short part, so you won't be missing anything in this webinar. Okay. Now, we need to be looking at gold from a historical perspective, and keep in mind that although gold has been bullish since 1999, look at this kind of beautiful uptrend. This is a log chart, so this is a chart looking at percentage changes in gold over the last 10 years or so. Keep in mind that even though gold has been up, it's been making higher highs and high lows, and it's more than quadrupled in value. When we look at the corrections or the volatility signatures in the gold market since 1999, we can see that there are some big drawdowns, and they're roughly around 25 to 30% drawdowns from peak to trough. And we can see here in 1999, we had a big drawdown period which lasted for about 2 years and a bit. 2006, we had another drawdown period, roughly 25 to 30%. Interestingly, and I think the most important drawdown is 2008 during the credit crisis, and then the current drawdown that we're having now. So I'm just going to quickly wrap up on that. The 2008 crisis is probably the most important lesson that we should follow. 34% decline in 8 months, and that was during a crisis. Despite having a crisis, gold declined by 34% in just 8 months. And so I think this is a similar analogy to 2012. The other point I'll just quickly make, just to wrap up, is that that was also at a time when the gold market was hitting a key psychological level, $1,000. And so it's very similar to what happened last year and this year. Gold was about to hit $2,000, and so that was a big psychological juncture, and for that reason, the market became overcrowded at these key psychological levels. Also, many people were buying, and so we had these drawdowns despite political and economic uncertainty. So the analogy is very similar to 2008, what we're having now. The big issue is that the world is temporarily running out of safe havens, and so gold has lost its safe haven status for now. So has the Swiss franc, so has the Japanese yen, and so has US Treasuries, although I think Japanese yen is changing over the next few weeks and months, and I'll talk about that in future webinars. Very last point I want to make is the reason why gold is going to be very bullish once we do get a resumption of the long-term cycle is because of what happened in 1990 and what tends to happen when commodity markets undergo a very bullish stage, they really gain in value. So you can see here, this is an old chart of gold in 1990 when it really had a massive acceleration point. So gold really is not in a bubble stage at the moment. I would say gold is probably in this kind of stage at the moment. We still have this upside to go, the green arrows. So be aware of that. We haven't seen a 1980 style parabolic spike or blow-off move in gold. That is still yet to come, and that is where investors and traders, all of us, will make our most money on the gold market. So we do need to watch out for this, but remember, timing is everything, and this is the point of the webinar. We're bullish on gold, but timing is everything. And so for now, be aware of this upside potential for when it happens, but for now, be aware of the short-term risks at hand based on the cycles that I've just discussed with you. That's it for me now. It's been an honor and a pleasure giving this webinar and sharing ideas with you. Enlightenment through realized knowledge. Sorry guys for speeding up the last section. I tend to focus a lot with, I try and keep it as interactive as possible, and sometimes I go over on the time. So just want to make sure that I stay in time with the FX Street team and give time for the next presenter, who I'm sure will do a fantastic job. Thanks guys for a fantastic participation, and I hope to see you next time for the coming webinar, how the market will influence the U.S. elections, Friday the 23rd of November at 2 p.m. GMT. Myself, Ron William, Principal Market Strategist at RW Advisory. If you have any questions that I wasn't able to answer today, please send me an email to ronwilliampr@gmail.com, ronwilliampr@gmail.com, and connect with me either on LinkedIn or follow me on Twitter on ronwilliams7. Okay, so I'm going to head off now. Thanks for all of your kind support and appreciation, guys. I can see each of you saying thank you and positive support to the webinar. You guys make this a very successful webinar, and it really is an honor for me to be giving these webinars each month. So thank you so much, and thank you FX Street for this opportunity. Bye-bye. All the best. See you next month.